All right, well, I'm excited to kick off this session on financing options for green, affordable multifamily housing. This session is approved for 1 hour in continuing education units, AIA, HSW, GBCI, and many others, as well as may be applicable to your state-based design or contractor license. Today I'll be your moderator. My name is Brett Little, and I am the executive director here at the Green Home Institute. We're a nonprofit to make healthier and more sustainable choices in the renovation and construction of the places we live. So we've got an all-star lineup for you here today. Our first presenter who will be joining us or starting is Rebecca King, who joined the National Housing Conference as a policy associate in August 2014. She works with the coalitions and communications with administrations, officials, and congressional staff on affordable housing policy issues. She also writes and produces NHAC policy materials, including regulatory comments, coalition statements, blog posts, publications, and the Washington Wire. She also helps lead the conference's Green Affordable Housing Coalition and supports many of the NHAC's working groups. And then we've got Rebecca here as well as the Senior Vice President of Stewards of Affordable Housing for the Future, SHAF, a nonprofit collaborative of 13 exemplary multi-state nonprofit affordable housing providers who own more than 125,000 affordable rental homes. Rebecca leads SHAF's energy and water conservation initiatives, including the Big Reach, which is a collaborative effort with its members to lead industry in long-term preservation of affordable housing by reducing energy and water use portfolio-wide by 20% by 2020. And then our final speaker today will be Mark Wolf, who directs the activities of the Energy Programs Consortium, EPC, as an energy policy research organization sponsored by the 4 national organizations representing the state energy program and regulatory officials. As part of his responsibility, he oversees the Warehouse for Energy Efficiency Loans, otherwise known as WHEEL, a national project to develop secondary market options for residential energy efficiency loan programs. So with that, I'm going to hand it off to Rebecca King, and thank you all for joining us here today.
Perfect. Okay. I also want to thank the other speakers, Rebecca and Mark, for joining us today. As you could hear from their bios, they're both really well-versed in this energy housing nexus. And I appreciate their willingness to help out today. So we are talking about financing green, affordable multifamily housing in this webinar, but that's a lot to do in an hour to an hour and a half. It's a really complex field, as I'm sure some of you are well aware. So we're going to come at this from a couple different ways. My presentation is going to touch on kind of an overview of just affordable housing finance for those who aren't familiar, and then a little bit of detail on some financing options available through utilities. Becky is going to touch on the owner perspective in pursuing green, affordable multifamily housing and some of the lending programs that are available. And Mark's going to close us out from a different perspective, looking at state energy offices, not always a partner that housers think about, but there's some real interesting options there as well. So with that, I'm going to dive in. For those of you who aren't familiar, NHC, the National Housing Conference, we are a membership-based nonprofit that works on the spectrum of affordable housing issues from homelessness to homeownership. We do policy research and communications work, and we are really interested in the intersections of housing. And one of those is housing and health, and we think that energy is a big part of that. When we make improvements for energy efficiency and green measures, we improve the health of the housing and the quality, which benefits the residents overall. So it's definitely an issue, an area that we pay a lot of attention to. As I mentioned, what I'm hoping to cover, an overview of affordable housing finance, touch on in a little more detail the low-income housing tax credit, options available through utilities, and then a brief discussion of challenges to financing green affordable multifamily housing is what that should say. We are very much focused on multifamily housing today. So for those of you who are familiar, bear with me as I get through this information. For those of you who aren't familiar with affordable housing finance, This is very much high level, and I'm happy to chat offline if you have questions and want to learn more. But presently, 3 federal programs are responsible for the majority of affordable multifamily housing in the United States. Low-income housing tax credits is one, public housing is another, and that is both physical housing units that a public housing authority owns, and then tenant-based housing vouchers that the PHA administers. And lastly, there's privately owned multifamily housing. So owners or developers come into HUD for either project-based rental assistance to make the units affordable or below-market HUD financing, or both. And that is predominantly how we are building or rehabilitating affordable multifamily housing. The reason I want to dig into the low-income housing tax credit is it's unique from the other programs in that not only is it our primary mechanism for new construction of affordable multifamily housing, it works very differently. This is very much a public-private partnership model. The program is actually not a HUD program. It's administered by Treasury and the IRS and provides tax credits that developers use to raise capital for the acquisition, construction, and/or preservation, rehabilitation of affordable housing. To give you a sense of the scale of the program, about 50,000 to 70,000 new units are built every year, and an additional 30,000 to 50,000 are rehabilitated. How it works in a little more detail is investors buy these tax credits, and in exchange, owners get cash equity that makes it easier for them to build the property. And by easier, I mean they have to find less debt and grants and other loans to make the project work financially. To get these credits, though, the property has to be affordable. A certain number of units have to be serving tenants at either 60% of area median income, that would be 40% of the units, or 20% of the units serving 50% of area median income. There's also 2 types of tax credits. There's the 9% credit, which is competitively allocated at the state level. So owners, developers compete for those credits through an application process that I'm going to talk about in a second. And then there's the 4% credit, which comes with state bond financing. That may or may not be competitive. It really depends on your state. And as I mentioned, these are affordable developments. Usually for 30 years, those states can impose longer affordability periods, and many do. While this is a federal program, it is allocated and administered by state housing finance agencies. And they do so by setting criteria and promoting objectives or what they want to see in these affordable housing developments in something called qualified allocation plans. So these qualified allocation plans, or QAPs, are released, again, it depends on the state, every 12 to 18 months. Some states are even moving out to 2 years. But it sets out the criteria that you have to meet in your project to be eligible for these low-income housing tax credits at a very high-level summary. Just a couple of examples of how HFAs are using these QAPs to incentivize green measures and energy efficiency. The Wisconsin Housing and Economic Development Authority awards points to developers who participate in Focus on Energy consultation, and Focus on Energy is the Wisconsin Utilities Energy Efficiency and Renewable Resource Program. The Connecticut HFA requires applicants to submit an energy conservation plan that includes their efforts to access energy efficiency funding from other sources. So those are just 2 examples of how they're kind of encouraging projects to pursue green measures. But additionally, the primary way is through this QAP more directly. And by that I mean, in 2014, 35 states awarded points for energy efficiency in their QAPs. So the project directly benefited in the application process by having energy efficiency measures as part of their development. Global Green conducted an analysis of QAPs in 2016 and found that 25 state HFAs are offering points or incorporating language around green building certification programs, so going beyond energy efficiency into things like LEED and enterprise green communities. And this survey also found that 10 years ago, in 2006, the average score in this analysis was 14 out of a possible 45 points. Now, in 2016, the average score is 35 out of that same 45-point maximum. So you can see how over the past 10 years, HFAs have really shifted, and the majority are prioritizing energy efficiency and green measures in their low-income housing tax credit program. My last point I want to highlight about this program, though, is it often requires additional funding sources to make these affordable housing developments work. So a property may just have low-income housing tax credits, but usually it will have tax credits, a first mortgage, home funds, state housing trust funds, local funding in some fashion, potentially project-based rental assistance, either through a federal program or another resource at the state level. Making these very complicated financing deals before we even touch on green and energy efficiency. Low-income housing tax credit properties usually have anywhere from 2 to 15 financing sources. So these capital stacks are complex. As an abrupt transition, I'm going to shift and talk about financing through utilities. And I'm doing this for a couple reasons. One, Becky's presentation is going to touch on some of the lending programs, but also, as I mentioned, it's complicated capital stack. Utilities offer some programs that can make it easier to finance improvements to existing multifamily affordable housing. But they are dependent on location. They're not universally available. But I did want to highlight a couple of what I think are good examples and give you a sense of what's available in the field. So PSE&G is a New Jersey utility, and they have developed a multifamily retrofit program in collaboration with the state HFA. So it is a holistic program providing resources for whole building retrofit. It includes a comprehensive energy audit that PSE&G pays for. As it says on the slide, it includes interest-free financing, as well as the option to repay the loan through the utility bill or on-bill finance, which we're going to talk about in a second. And there's also guidance available to help owners solicit contractor bids. So the idea with this holistic approach is to overcome some of the obstacles that multifamily properties face. Another good model is the PECO utility in Pennsylvania has a smart multifamily solutions program. So this is designed for retrofit projects in both master metered common areas, which the owner pays for, and individually metered units. So the tenant pays that energy bill, or that's one common model. So this approach addresses both the residential and commercial meters, streamlining the process for the owner. And this is one of the challenges of multifamily housing and multifamily affordable housing is that utilities treat it differently. Some treat it as residential, some treat it as commercial, or some treat it as both. So they need to create programs that look at that appropriately, like PECO has done. And Duquesne Light, also a Pennsylvania utility, has created a multifamily housing retrofit program that provides energy efficiency audits and financial incentives, as well as assistance to owners in evaluating the measures, soliciting contractors, and integrating funds from other sources. So I did just want to highlight those good models and let folks know that there is a website, desireusa.org, where you can go to see what's available in your area, not just from utilities, but from the state level and also federal rebates and that kind of thing. But it's a great resource to check out. Utilities are not universally active in serving multifamily housing, especially multifamily affordable housing. ACEEE conducted a study and found that with the 50 metropolitan areas with the largest multifamily housing stock, only 30 had utility programs targeted to multifamily housing. So 20 had no programs at all. I mentioned that just to say that there's a lot of opportunity there to engage with utilities that aren't doing this work, but also that 30 out of 50, there are utilities actively looking at this sector. So there's definitely some good models, some good programs out there, and potential for more. And I just wanted to make folks aware of that. Shifting to on-bill finance, in case folks need a review of the concept, basically you invest in energy efficiency improvements and repay for the cost of those through charges on your utility bill. So the benefit is there's no upfront cost, and you're already a utility customer, so you can set this up usually more easily than getting a debt from a conventional lender. And going back to PSE&G, they have an on-bill program specifically for multifamily building owners, both affordable and market rate. They conduct an energy audit and then look at measures with a payback of 15 years or less. And PSE&G will also help contribute to the cost of those measures. And then the owner just pays them back on their utility bill. Common measures include lighting, HVAC systems, ventilation improvements, insulation and air sealing, appliance upgrades, and installation of water-saving measures. And PSE&G has funded about 50 projects through this program so far. I did want to briefly touch on challenges to green affordable multifamily housing finance. What a mouthful. And a couple of things that I'm sure Becky will also touch on in her presentation. But I talked about the complicated capital stack for low-income housing tax credit properties. These layers of financing make it really challenging to take on new debt or existing properties that need energy retrofits. So programs attempting to serve multifamily housing have to take that into account, which is why I talked about utility programs. They do offer some options that can address some of that. And upfront cost is also a challenge because you either need to take on new debt or have surplus cash. And for affordable multifamily properties, excess cash is hard to come by. And then there is the split incentive. So for properties where the owner pays utilities for the master metered section, but tenants pay their own utility bills, there's not much of an incentive for an owner to make improvements to tenant space because they're not going to see the benefit in terms of savings. But a huge caveat, some owners pay all the utilities for a building, the whole building's master metered. For buildings with fewer financing streams, the owner could benefit from reducing utilities because then they can raise rents, but it really depends on how that property is financed. The split incentive and understanding it is definitely key for thinking through energy improvements to multifamily finance. So in closing, I did want to provide a few resources for folks in that Desire USA website as well. And also make sure folks were aware of Energy Efficiency for All. This is a collaboration of organizations working on linking the energy and housing sectors for multifamily affordable housing that I encourage you to check out, as well as the Network for Energy, Water, and Health in Affordable Buildings. And there is my contact information. And with that, I'm going to turn it over to Rebecca Schaaf with Stewards of Affordable Housing for the Future, or SAFE.
Great. Thank you, Rebecca. It is a strange world we work in, and I think that was a great, very clear overview of affordable housing, some of the barriers, and the opportunities that we have for energy efficiency. So I'm going to be talking today about programs that promote energy efficiency in the mortgage lending process. My name is Rebecca Schaaf. I work at Stewards of Affordable Housing for the Future, or SAFE. And just to briefly introduce SAFE, we are a membership organization of 13 nonprofits, which, as you can see, have a pretty broad portfolio across the country. We work in that privately owned assisted as well as LIHTC housing that Rebecca introduced, and are really exclusively focused on affordable multifamily rental properties. Our members are all quite committed to running efficient portfolios. We have, over the years, run some demonstration programs focused on financing retrofits in between capital events, and ran into many of the barriers that Rebecca identified, including simple capacity issues that, these organizations run on thin margins, they're fairly thinly staffed, so running kind of special projects poses some difficulties. So I'd like to talk a little bit about how addressing energy and water efficiency in the mortgage lending process addresses some of these barriers. So first of all, the properties don't have a lot of money to capitalize improvements on an everyday basis. But when you're taking out a mortgage, you are getting an influx of capital. So you have money coming into the property that can overcome that capital barrier. Also on the capacity side, you have a project team engaged working on a acquisition, rehab, or new construction process at this point of time. So while you may need to complement that team with some energy expertise on a consulting basis, you're not pulling your staff off of other projects to do a particular energy retrofit. Importantly, this is not disrupting the capital stack. I think, as Rebecca mentioned, these properties also often have kind of a lasagna of financing on them. And if you're going in outside of when you're taking on a new mortgage, you do need to get approvals usually from all of those existing lenders. So you save a lot of administrative costs by going in when you're taking out a new mortgage, when it's that kind of clean slate on the financing. Mortgages also, by the nature of being long-term debt, are able to accommodate measures that have long paybacks. So you can get to larger scopes in this kind of financing. The demonstration projects we did often had financing terms up to 10 years, kind of was the outside. And when people are using their own capital, they often want even a faster payback, maybe on a 2-year kind of time frame, which really limits what kind of measures can pay back in those time frames. Similarly, when you're already replacing equipment, it makes sense to focus on marginal costs and additional efficiency. So you're not necessarily looking to the energy savings to pay for the whole amount of the equipment. You're just thinking, is a little bit more cost of the energy efficient option going to pay back through those additional savings? So for all of these reasons, when a property is taking on a new mortgage, it's a very opportune time to look at energy efficiency. So how does it work to promote energy efficiency as part of mortgage underwriting? Well, one thing that can happen in these energy efficiency mortgages is that you can be allowed to take on a larger loan by looking at energy savings. So this is similar to how you may be familiar with single-family lending, where they look at debt-to-income ratios. In the multifamily space, they're looking at debt service coverage ratios, or kind of addressing the question, by how much does your expected income exceed your expected expenses? So as your expenses go down, you can see that you've got a better coverage ratio and can afford a larger loan. Now there's a little bit of, this is a little bit of a mixed benefit. You definitely want that opportunity, but there's also some wariness to taking on greater debt that's based on projected savings. People are, developing fixed expenses. Their mortgage payment comes due based on a projection that they're not necessarily confident in. So one of the ways this gets addressed is by discounting projected savings. Lending programs typically don't look at 100% of the projection. What they do discount those sometimes to 75%, sometimes on the tenant side as low as 25%, because that's really getting you a more indirect benefit. Offering reduced interest rates is another way of reducing the risk to borrowers. The reduced interest rate can just lead to flat-out savings, or it can kind of mitigate. You're taking on a larger loan, but you're not paying that much more on a monthly basis because you have a lower interest rate. So these are a couple of the mechanisms that green lending uses to promote energy efficiency, and they sometimes come with other green lending perks, such as covering the cost of audits. So I'm going to be talking about 3 national programs that promote energy and water efficiency in mortgage lending. There are probably countless other bank lending, green lending programs, but these are really the ones in a national scope. And I'd also like to say we at SAFE don't have any role in administering these programs, but we are participants in the programs. Our members use these programs as owners. So the programs that I'm going to talk about are from Fannie Mae, Freddie Mac, and the Federal Housing Administration. As you may be aware, Fannie and Freddie don't actually do direct lending. They buy mortgages, and all of these organizations have kind of designated lenders that can sell mortgages to them. Similarly, FHA insures mortgages. So these programs are available to other lenders to implement on their behalf. But because they are big national organizations, have a large influence on what lenders that are buying into or selling their products to Fannie, Freddie, and FHA can use. So I'm first going to talk about Fannie Mae's Multifamily Green Initiative. I've put them first not only because they are alphabetically first, but also because they were real leaders in the multifamily green lending space. And this was the first of these programs to come out. So as you see similarities, you can get a sense that other organizations, really used Fannie Mae's pioneering experience. The first program they offer is a green building certification price break. It's very simple. If your property meets one of 7 recognized national green building standards, you get a lower interest rate. So it's knocking down the cost of your loan by building to a green standard. So as they purchase these loans, they're able to sell them as green mortgage-backed securities, and there's a real clear kind of qualification process. Their other program is the Green Rewards Program, which bases its qualification off of an energy audit. So they're looking for properties where an energy audit shows at least a 20% reduction in either energy or water. So what we found is that for many properties, at the time when you're replacing so much equipment during a rehab, this 20% reduction is quite achievable, especially on the water side. And Fannie Mae does have a protocol for the audits that the lenders participating in this program can order audits based on Fannie Mae's high-performance building module to submit the data and show that the 20% savings is expected. The benefits under Green Rewards are, again, a lower interest rate. They also underwrite 75% of the owner costs, as well as 25% of the tenant savings, so enabling a little bit larger loan amounts through that underwriting. And then a recent addition is that they will reimburse the cost of the audit for properties that ultimately go forward under the program. Freddie Mac over the summer introduced their Green Advantage program. You'll see it's fairly similar. They also have a Green Certified program with, again, 7 green building standards that are recognized as qualifying for a lower interest rate under the Green Certified program. They also have their Green Up and Green Up Plus program, which differs from Fannie Mae's program in a couple of ways. For one, they're only looking for a 15% reduction in either energy or water, so a little bit lower bar to get into the qualification for the program. And then the second difference is that they do have this kind of 2 levels of assessment and underwriting. The green assessment is an audit that's kind of more like an ASHRAE Level 1 audit. And based on that assessment, they will underwrite up to 50% of the savings. Or the Green Assessment Plus is closer to the ASHRAE 2 audit, And based on that, they'll underwrite 75% of the projected savings. Under either of these green assessment pathways, you do get a lower interest rate and a reimbursement of up to $3,500 for the assessment. For the Federal Housing Administration, which is a part of HUD, they are mortgage insurers. So they charge an insurance premium on top of a loan in order to provide that insurance. And their incentive program is an insurance premium reduction. So you're paying more on your mortgage if you are under this program where you qualify for, they have 6 green building standards that can qualify you for this program. And the other commitment is to achieve and maintain an Energy Star score of 75 or better. So it's putting your properties into Energy Star Portfolio Manager, looking at that score, and that basically is the equivalent of being in the top quartile of multifamily properties. The benefit here is that mortgage insurance premium is reduced to 25 basis points or 1/4 of a percentile. And, the standard that you could be reduced from is between 45 and 70 basis points. So a pretty substantial reduction. HUD also has in its MAP guide issued its perspective on underwriting savings, which includes that properties applying for loans where they have an ASHRAE Level 2 audit and commit to benchmarking. For this one, you don't have to achieve a specific score. You just have to provide the information. They're willing to underwrite 75% of savings from an ASHRAE Level 2 audit. So these are just 3 examples of national programs that promote efficiency in mortgage lending. These can be combined with the utility programs for incentivizing, so it can help drive down that additional cost to the energy efficient options. There are a wider variety of financing options available outside of the mortgage process as well. And the last thing I want to just briefly share is DOE website. It is still up. I checked this morning, but through the Better Buildings Solution Center, DOE is providing kind of an overview to some of the financing options available to many, many different building types. But it's a good resource to get introduced to some of these other options as well. So with that, I want to thank you and also turn the presentation over to Mark Wolf from the Energy Programs Consortium.
Thank you, Rebecca. I'm just trying to move the slides. Thank you. Thank you. I'm Mark Wolf. I'm the director of the Energy Program Consortium. And just briefly, one more technical thing. There we go. Briefly, we're a state-sponsored organization, and we're sponsored by the 4 groups that represent all aspects of state energy activity. There are 2 organizations that focus on low-income energy, the National Association of State Community Services Programs, which focuses on weatherization of single and multifamily buildings, and the National Energy Assistance Directors Association that focuses on bill payment, or the Low-Income Home Energy Assistance Program. And lastly, the 2 other organizations are NARUC, the National Association of Regulatory Utility Commissioners, which represents the state regulators, and NASIO, the National Association of State Energy Officials, that represents all the state policy people. So adding to the comments of the last 2 speakers, here's the opportunity as well as, I think, the complication. It definitely is a lasagna of programs, as Rebecca said. Part of what makes, I think, this a challenge for the people who are listening is that we do have a variety of programs. most of them come from state housing finance agencies, and some, and a minority of programs come directly through state energy offices. We also sponsor grant programs, and so the challenge is linking our programs up with your capital stack. We have our own timelines, our own processes, and I think sometimes they get in the way of the financing of your buildings. And we try really hard to address that, but it doesn't always work well. And so I think that often our programs aren't used for that reason. But that's also the kind of feedback that's really important for our state energy officials to hear when you run into problems accessing the types of loan programs we've developed, that you let them know, because often they just hear silence. And the other piece is that we don't have a universal set of programs, so each state's program is a little bit different. And I think so it makes it a little bit difficult to generalize. And the last piece I'd like to mention before I talk more about my formal presentation is that many of our multifamily programs on the state energy side developed out of single-family programs. And I think that's sometimes useful to recognize that our language sounds very single-family, where in fact we're trying to reach the multifamily sector, especially in our loan programs. They're very similar, the two aspects. The other piece, and this was mentioned earlier, and I think it is something that is of concern, most of the numbers you get from our energy audits are modeled numbers. And there have been studies that have suggested that in real life, the savings might only be 50 to 75% of those modeled numbers. So if you look at them, you think, God, they seem high. In fact, studies have indicated that sometimes they are. There was a Deutsche Bank study done a few years ago that suggests the numbers could be about 50 to 75% of what we project. And I think when you look at those numbers, the other piece, and I think this gets into the cost effectiveness numbers, if you think of energy efficiency and renewable energy as a pyramid, the activities at the bottom of the pyramid, like lighting and insulation, are extremely cost effective. Those numbers will suggest they can pay back in 3 years. And in fact, that's true. We have lots of studies that show that those are extremely good investments. So even if they pay back in practical sense, say at 75% of what's been projected, there's plenty of room there to make those investments. So instead of a 3-year payback, maybe it's really 4, but still extremely cost effective. Other things like windows, while they make an improvement to the outside of the building, they do add to comfort, their payback numbers are much longer. So those are the kinds of things that when you look at decisions in terms of improvements to your buildings, that those cost-effectiveness numbers can be extremely helpful. As I was saying earlier, there really are very few programs of the multifamily that come straight out of the energy office. Sometimes the energy office works with the housing office. Sometimes they work with the utility. So it's almost a partnership in many states, but not a formal partnership in the sense that you have seamless transitions. So it can be challenging sometimes to try to stack the programs in a way that works seamlessly for your buildings. Nevertheless, I think the effort is worth it, and we have examples where people have done this successfully, and the resulting savings are significant. So one of the issues is often lack of awareness about the programs available in your jurisdiction. Just because you called the utility doesn't mean the utility knows what the Housing Finance Agency is offering. You have to do that kind of legwork to find out the full range of incentives. We don't often have good data on energy consumption that can show practical savings versus modeled savings. There's a challenge of split incentives, the savings versus the tenant versus the building owner. So, for example, you might be responsible for hallway lighting and hot water, but you're not responsible for individual heating. So how do you make those investments where you get the savings go back to help pay back the loan? We also have a series of programs that sometimes, again, it's the leveling. So many states will offer grant programs, usually paying about 25% of the cost, but that's not enough to cover the payback from the investment. So it's whether you have to find financing on your own or use one of these other programs that have been mentioned, and then seeing whether the cost effectiveness numbers work. Let's see how we move this. Okay. One of the programs that I think is kind of an emerging model that is really designed for a low-income multifamily is the Connecticut Green Bank's low-income multifamily loan program. We follow the HUD rules, 5 units or more. For definition, what do we mean by low income? There is no national definition of low income. That adds to the sense of confusion. Connecticut is using at least 60%. 60% of the residents have less than 80% of area-wide median income. Some states use 150% of poverty when they're using the weatherization assistance program. So there's a certain amount of confusion at times about what the definition is that gets you into this program. So I'm hesitant to say that every state uses the same numbers, but this is pretty much the ceiling that you find when states have programs. The other piece that states have been looking at is broadly beyond just straight energy efficiency and renewable energy. There's been a lot of interest in health and safety issues, especially water savings. We have water leakage that can create mold problems, the whole sort of the healthy homes discussion. But yet there's some concern about what percent of the loan would go for non-energy measures. So Connecticut's a good example where, let's say, 25% of the proceeds can be used for non-energy efficiency measures. And the reason we need 25% is that the state resources that go into energy are basically tied to the utility bill. So even when they pay their utility bill, a certain fee goes towards the green bank. And so those numbers have to be cost effective for energy savings, but we recognize that if you're going to go to do the work on the building, let's look at all the related measures that tie to the energy system. The Connecticut loan has an attractive rate, 5 to 6%. It's also unsecured, where in fact, you know, I think we would prefer to do secured lending. We realize that a secured energy loan creates problems with existing financing you have. So states have been trying to do unsecured loans where possible. The other pieces that I think are really very attractive about the Connecticut loan program, and I think this is maybe one reason people sometimes are a bit hesitant, is that Connecticut will pay 75% of related costs. And those related costs are essentially the cost of an energy audit, which can be quite expensive for a multifamily building. The idea is that the building owner will put up 25%, so they have some skin in the discussion. Otherwise, the state would end up just doing free energy audits across the board and would have a very small percentage of take-up. The idea is that if you put up 25% of the cost, then it's more likely you're invested in doing the retrofit. What Connecticut has also done, and we've seen in a couple of other emerging programs, is hire intermediaries to help the building owners. They've hired New Ecology, a company based, I believe, in Massachusetts, to help to do the energy audit and also help think through and prioritize measures, which is extremely helpful. Also, as part of the audit, what Connecticut does is they identify other incentives that are available, including utility incentives, tax credits, and other funding sources. As a result, you're likely to capture all the grant money that's available and maybe get the loan down to about 50% of the cost. The reason that's important is that after you go through all the ways that the energy savings may or may not materialize based on the audit, if you can get grant resources up to anywhere between 35 and 50% of the cost, it's almost guaranteed that the energy savings will pay back the loan. Another program that's an interesting model is Michigan Saves. It's not a large program. It's, again, an unsecured loan. Rates are 6 to 10%. Terms are 24 to 60 months. And the financing really is based on the building needs. So it can go down as low as $2,000, which I think, again, is thinking maybe more like a single-family building, to $250,000, which is more realistic, I think, for, a 50-unit building. They've done 20 projects, and the average project cost is $556,000. So, again, a fairly large building. Average bill savings about $13,000. And the payback is over 6 years. So I think that the Michigan program is more a traditional model. They don't pay anything towards the audit costs. So to participate in the Michigan program, the building owner has to essentially invest possibly $10,000 to $15,000 before anything happens. The Florida Multifamily program is a new program. It's very similar. What they do that's a little bit different, though, is that they'll make the money available at 0% interest for nonprofit applicants and 1% for for-profit applicants. So where they don't pay for the audit, they don't provide any grant money, what they do instead is provide a very, very low interest that increases the odds that the savings will pay for the amount borrowed. Nebraska is a similar program. It's a revolving loan fund, so they don't have new capital that comes into it, like, say, Connecticut does. They basically, as the money gets paid back, they make new lending. They've had a lot of success with this program. It's been going, I think, for more than 10 years. And again, though, they don't provide the audit costs. It's a straight loan. And I listed a few other programs. Again, you can see they're all different interest rates, which I think makes this very interesting. Some states, though, like Maryland, is offering will pay in some cases for the audit. Maine will also pay for the audit. But again, you can see the interest rates. Maine is 4.75%. Florida was 0%. So everyone takes a different approach. And some of that's based just on preservation of capital for the state program. The other opportunity that is still evolving around the country is the PACE program. For those who aren't familiar with it, in a very simple way, PACE is a way to make the energy investments to your home, to your building, and then the payback is through the real estate bill. So it's a different sort of formula for payback, but it's the same sort of process. There haven't been a lot of examples of PACE multifamily done in the United States. Most PACE has been straight commercial or single family, primarily in the state of California, although we're now seeing PACE emerging in Missouri and Florida. And the two examples that we know about in D.C. have been, again, very specific buildings. And when the language is PACE assessment, we don't call them loans. They really call assessments. They're added on to your real estate bill, and they do require a lien. And I think that sometimes becomes a problem for building owners that already have existing financing, and the bank objects to a lien because the lien on a real estate bill goes in front of the mortgage. But again, it's a promising approach. And I think to sum up my comments, state energy offices, are not designed to do specific multifamily lending, but they are moving into this area, and there's an awful lot of interest at the state level. The kinds of things that I would suggest, I think the Connecticut model is attractive because they're not only offering a lower interest rate, but as part of the process, they seek out all the other financing, all of the grant money that's available. I think it's important to reach out to your state energy office, to call them, let them know that there's clear interest in multifamily retrofits and you'd like to work with them. And I think since the programs we have are still relatively small, that's important to get feedback about how effective they are for you, how easy they are to work with. I know that when I've met with multifamily building owners in the past, they'll sometimes say the program is too difficult, it doesn't line up with our capital stack, but they never call. And so the energy office just doesn't get that kind of feedback. Or here's a good example. We really like the way it's being done. in Connecticut. We like the way it's being done in Chicago. Can you do that in your state? And that's the kind of feedback that I think is really, really important to help engage energy offices more in this important work. Thank you.
All right. Thanks, Mark. Thanks, everybody. We've got some time for questions. We've got several questions that are already pouring in. Please start putting your questions in, and we'll definitely get to as many as we can. Real quick, for those of you looking for your continuing ed, the survey will pop up once you quit, or the same survey will be sent to you in your email for attending. So whether you need CEUs or not, we appreciate if you can take it. If you're watching the recorded version of this, make sure to take your 10-question quiz with an 80% passing rate to receive your certificate. And thanks to all of our members, board of directors, our sponsors listed here who allow us to do what we do. And thank you all for joining us. So some of the questions coming in, and I guess I'll just let each of you, Mark and Rebecca chime in on when you'd like to, or who wants to answer. I think I have a pretty good idea of when some of these came in. So I know, Rebecca, when you first started talking, a question came in on bill financing, something about, let's see, on on-bill financing, when Renew Financial acquired AFC First, which had contracts for OBF in most states, Renew closed down the multifamily OBF lending after the acquisition. OBF engages the utilities. Has Renew revived the multifamily OBF program?
Well, that is a very specific question that I will look into, and I didn't see that in my chat box, so I didn't Google it during the presentation. I apologize, but I will look into that. I did see a couple of questions around on-bill that I can address. One was about how many on-bill programs there are, and there's not a great kind of cumulative or universal list that I've been able to find. What I have been able to find is that at least 25 states have utilities with on-bill finance options. Those are primarily in the Southeast, the Northeast, and the West, with Texas, Ohio, Illinois, and maybe another Midwest in there. But it seems to be more regional in nature, at least so far. And then there was a question about if, with on-bill finance and a 15-year payback, if an owner is required to purchase energy from the utility company. And that's a good question. It's not entirely clear to me. I do know that the on-bill debt, what's remaining, transfers with the property, so if it sells, typically for like single family, it would just stay on the utility bill for the new owner. But utilities are setting these up differently. So PSE&G, for example, the balance is due on the sale of the property, but there's also no prepayment penalty. So it takes, I think it's very much utility specific about how that works. And if they set it up as a loan versus a tariff, on bill, you can get into the weeds on this and have a webinar just about that. So sorry that I can't provide more clarity there.
Yeah, one thing I could add is, Mark, we do a lot of work with Renew, and at this point they don't have a multifamily program that's set up. They're primarily focusing on single-family pace.
That's usually the opposite of what happens. Thanks. Another question that came in here was sort of differentiating some of these resources on new versus existing. And I think it primarily came in during Fannie Mae and Freddie Mac, though I think it could be extended out to any of the programs we talked about. Would you say a majority of these programs are only serving to improve existing, or can some of these financing tools like Freddie Mae or Freddie Mac and Fannie Mae be used for new construction?
So this is Rebecca Schaaf, and I would say all of the certification programs are very well suited to new construction. that you can get reduced interest rates by achieving a certification. A lot of those certifications are very geared towards new construction, so all of those are very good opportunities in new construction.
This is Mark. The state programs are split. Any money so where you have layered grant and finance money for low income, any money that comes through the federal weatherization assistance program or the low income energy assistance program, there's about $600 million that comes through those two programs for energy efficiency improvements for low-income housing. Those programs have got to go by law only for existing housing. They can't be used for new construction. So that's the split there. And most of the state energy programs are targeted towards existing construction.
Like the utility rebates?
Yeah, those are rebate programs. The loan programs are targeted towards existing rather than new constructions. I think they pretty much follow the federal weatherization LAHI programs. Those two programs have pretty much set the tone for state energy interest.
Okay. Mark, this question came in while you were talking, and I think it says, is there data available on what all of these state programs have originated? But perhaps you meant to say where all of these state programs have originated. Any background information on that?
Well, the Desire website lists where the programs are. Is that the question?
Oh, so all those, like Michigan Saves and
Yeah,
Nebraska, that will have all of those programs?
Yes.
Okay.
Look. I'm sorry, go ahead.
Oh, I would say the question might be a little bit deeper as to where they came from before that. So I suspect they would have to investigate each local program to determine where it was developed.
Is the question really more possibly just what volume is being originated by each program?
I'm not sure, Jim. If you're still with us, feel free to elaborate while we get to another question here.
Right. One of the advantages of looking at the Desire website, because it's very comprehensive, you can then see the layering opportunities. So you could be in a jurisdiction where there's a utility program, a state program, utility loan program, a state loan program, similar grant programs, and then the creative side is how to put those together. And I think it can be challenging, but if you're lucky to be in an area where there's multiple sources of capital, if combining those can greatly reduce the cost of the retrofit.
Yeah, absolutely.
And this is Rebecca. I just wanted to chime in. For folks looking for a little more information on residential loan programs, I think it leans single family, but Mark's organization, EPC, does have a report on their website. It's a little dated as of 2013, but they also have a multifamily paper as well that I encourage folks to check out. And other resources that may be helpful, ACEEE has done a lot of work on utility finance, and Natural Resources Defense Council. They have some good research products if you're kind of looking for more exhaustive treatment of these topics.
Great. So yeah, it looks like the question was how many of these loans were originated deals, loan amounts, number of units through each of the state programs. So did you say there was a place that was all bundled somewhere, or would that have to be individually looked at in each state?
So EPC has a paper on residential loan programs. I do think it leans single family, and there are some papers looking at this, but I don't think any are super up to date or exhaustive. But the Desire website, you can really get a good sense of what's available, not necessarily of their scale, but
Sure. Well, that would probably have to be more. You'd have to look at each program individually and see what they're reporting out.
Yeah, and here's the thing that I think is worth adding to that. the table that we have on our website, what we found was that the loan volumes are very low. That when we've talked to the state officials, their feeling is that they don't get a lot of calls from multifamily building owners. They would like to talk to more of them. They put these programs together with the idea that sort of like build it, you will come. And I think that if you're in one of the, I think we identified 13 states that had programs. If you're in one of those states, I would call the state energy office. They're all under the National Association of State Energy Officials, or NASEO, and talk with them about the program. Does it work for you? And if it doesn't, let them know, because they do have flexibility. And I think there's a feedback problem sometimes, and that you might look at it and say, gee, that just doesn't work for me, but if it was this way, I could use it. And so that's really helpful feedback for them.
Thanks. So a specific question came in about utilizing low-income housing tax credits, LIHTC, along with PACE, Property Assessed Clean Energy. Is that possible? Has anyone seen that done?
I have not seen that done, and I think, as Mark mentioned, PACE for multifamily is just not really taking off yet the way single-family PACE is, and the lien issues are going to be even more complicated in a tax credit deal. So it's not an area where I expect to see a lot of development, but I could be wrong about that, and happy to defer to the other speakers.
I would concur with that. You know, there's not a lot of multifamily PACE going on, and I don't know about the particulars of tax credit properties, but adding financing to tax credit properties is often more complicated than, you know, strictly mortgage finance properties.
So I have a question on the, this topic came up quite a bit about the actual predictability of the energy modeling and predicting the savings, and you know, having some concern about that, or obviously overall reducing what the predictions have been. What are the thoughts on using that in conjunction with actual third-party performance testing? Do you see any success stories there where after the model is set up to predict the savings, after the project is completed, that it's actually inspected to ensure that everything was done accurately, so that the savings might either be adjusted after the construction process, or that there's more assurance done, during that post-construction testing phase to to make sure everything was in there, and make sure that the model is more accurate.
So I would say that, commissioning and going in after construction to verify that things were, actually built as designed and are functioning as intended is an important and very widespread practice. The importance of being able to rely on projections, though, is that, a lot of these things really need to be nailed down up front. You need predictability on how much of the savings you're going to underwrite. You don't want your loan amount changing kind of after you've closed. So for now, I think the discounting of the savings is the model that we're working with. And the more long-term monitoring that's going on is looking at the whole building utility consumption and monitoring that over time. So it's a little bit different than monitoring performance of particular measures, but does give you a sense of, on the building scale, when these whole building rehabs happened, what is the effect over time? So that data is being collected and will allow program designers, program administrators to, look at how much of a discount do they use, where are we getting savings projections off the most? Are there particular climate zones? Are there particular technologies. So I think we will be able to revise this over time so that we are realizing closer to that 100% of the projected savings. But it'll just take, some time doing the monitoring, revising the projection systems, and the discount rate is what kind of protects us right now, the discounting of savings.
Yeah, it makes sense. And I think Jacob here, who chimed in mentioning that, if someone is following a green building program like LEED or National Green Building Standard to get their incentive or discount, those types of items are already required. So in that case, it might be it might be taken care of there.
This is Rebecca. I just wanted to go back to the question about PACE and multifamily. A couple of the audience attendees let us know that both New York and Michigan only have PACE for multifamily, and I went on Energize New York's website just now, and they do have 2 affordable housing projects that have come in through multifamily PACE. So those would be great examples to reach out to if you're looking for how they made that work. One was Drum Hill, affordable housing for seniors in Peekskill, New York, and then the other was, hold on one second, Robson House in North Salem, New York. So just wanted to share that with folks.
Thanks, Rebecca. And yeah, we actually just did a session last week, so it's on our USGBC and YouTube channel, all about PACE for residential building, single family and multifamily. And we do cover some. We didn't catch the one in New York, but we cover one actually in Michigan that's kind of under the radar too, up in Greenville, that did a whole retrofit and actually added solar. Pretty low-key project, but pretty neat that it had solar, low-income housing affordable project. So it is happening. Well, that's all the time we have today. I don't see any other questions here. So I want to thank everyone for joining us. I want to thank our panelists. And just real quick, in order of your presentation, starting with Rebecca from the National Housing Conference, where can people find more information if they want to learn more?
So our website has some resources. The Green Affordable Housing Coalition website has some resources as well. It's a little dated. And you can also reach out to me, rking@nhb.org, and I'm happy to help out and connect people with some of our members who are doing this work.
And Rebecca Shop?
Yeah, so you can see my contact information is on this final slide. Our shop at safenet.org and SAFE's website, www.sahfnet.org, also has a number of energy efficiency tools, resources, studies that we've put together.
Great. And Mark from EPC?
Yes, our website, www.energyprograms.org, has a section on multifamily housing, including the tables that we've prepared. The other place I suggest going is to the National Association of State Energy Officials, or NASIO.org website. You can then link to each state energy office, and if there is a multifamily energy program, that will take you to that. The other place to look is the Public Service Commission website, and you can get to that by going through the National Association of Regulatory Utility Commissioners, or NARUC, NARUC.org. In some cases, the Energy Office runs through the Public Service Commission, like in New Jersey, and that will take you to the programs that they offer. And I think you then complement that with the ones that you see in housing finance agencies. And then lastly, the Desire website, we've mentioned several times, does a pretty good job, actually a very good job of listing the programs that are available by utility and other jurisdictions in your state. So between those three, that gives you a pretty good sense of what's offered from the energy side. I wouldn't rely on just one because programs get missed, programs change. I would also go to your local utilities website. Some utilities offer fairly aggressive programs now, and they don't necessarily, again, always get picked up by one of the other websites. So I think those should get you a pretty good sense of what the state energy network offers.